have with us Moshe Katri, Managing Director of Wedbush Securities Equity Research, joining in. Moshe, it's an important morning, and I'm glad we got you today instead of yesterday, even though it'd be better if you were with us on Zoom. What are you making of Accenture? There is no growth in Accenture's consulting business. Discretionary deals are still not happening. What is their guidance going to mean for Indian IT firms?
Hey, good to be here, and apologies for having to reschedule. We're still suffering the result of power outages because of the storms here on the East Coast. So, Accenture's numbers are not a big surprise. We spent some time in India maybe a week and a half ago, and we did hear that in general the large cap names continue to be relatively cautious about the near-term spending environment. The common word that we heard was hesitant, and it seems that the enterprises are still hesitant to spend on anything that's discretionary. We continue to see large deals that were won maybe 6 to 9 months ago with slower than usual conversion rates, and we're still probably 2-3 weeks away from the completion of the budget cycle, so you don't have a lot of visibility on that. So we're not really surprised to see Accenture's numbers. We're not really surprised to see Accenture's guidance for the February quarter, which was below our expectations. And I think in general, there's definitely a focus on the macro. And one of the things that we heard, and it's probably a good thing, is that enterprise clients are very focused or super focused on one main economic metric, which is interest rates. And there's a correlation with the intention to spend with moderating interest rates, i.e. the Fed's intent to stop raising rates. So, there's an expectation that this actually will bode well for discretionary spending down the road. But going back to what I said, Accenture's numbers are not surprising. These are typically, when they report their numbers for the November quarter, they're typically muted. And there isn't a lot of visibility into the next calendar year in terms of budgets, given where we are right now. So, again, pretty much in line with expectations.
Moshe, October to December, seasonally also is a weak quarter. You did mention that the word was caution, hesitant, and that is very obviously seen on the long-term deals or deal-making in that sense for the larger IT players. When do you think larger firms will begin to see an influx of long-term contracts? Are there any on the table right now?
So the deal flow, and when we talk of large deals, we're talking more about the cow stakeout deals that have really become very popular, given the fact that many enterprises are going through some financial turmoil. So the deal flow is actually pretty strong, but the issue is more about conversion. We are hearing that we'll start. Enterprises are kind of telling vendors to start ramping. And I'm assuming you're going to start seeing that inflection point in the June quarter. March is typically weak, as you know, for the industry, and we believe that the December quarter will probably be impacted because of furloughs and because of the wage hike increases that at least 2 of the large names implemented during the December quarter.
Right, Moshe, I'm going to pull in 2 questions into one because I think we're running out of time, but very quickly, the rupee is set to get stronger. What is that going to do for margins of IT companies? Because one, you're hit on revenue, and then a stronger rupee is going to impact your margins, so it cannot be a good place to be in. Secondly, Tier 2 companies are competing at a lower sort of margin. They're going for smaller deals, puts them in a little bit of a tougher position than your large cap IT names are. How would you approach the difference between the Tier 1 and Tier 2 companies? I know you closely track the likes of an Infy, HCL Tech, and TCS, but just break that down for me. And also, a quick one, what are your thoughts on ER&D space? That is one space that looks pretty hot in India, at least.
Yeah, so a lot of questions and kind of bundled in one, right? So I would say a couple of things. we've definitely seen a disparity in the commentary between the tier one kind of large cap names versus the smaller cap names. We visited a couple of smaller cap names that focus predominantly on digital, and they actually seem pretty bullish. Globant, EPAM, ThoughtWorks seem to be actually doing well. They've had some pretty aggressive recruiting plans in India, and that was in 2023, and that will repeat itself in 2024. But these companies also are a bit different. They're smaller. Each one has its own kind of story. Globant has an outsized exposure to Latin America. That continent is doing well. EPAM, it's more about their ability to build traction in India away from Eastern Europe. ThoughtWorks, it's more about their APAC division that's doing better after 18 months of really weakness. So that's really the big gap, and that's why I think the small cap names are doing pretty well. My biggest concern, and again, as you said, we're probably getting to the end of this session, is really expectations, Street's expectations for the group. And, I think the Street is probably a bit ahead of itself in terms of excitement about the next 6 to 12 months. And the Street is forgetting that you do have some uncertainty, at least for the next few quarters. So it seems that expectations are a bit too aggressive for the space right now.
Right. Thank you for that, Moshe Katri, there, setting the stage for what the Accenture numbers mean for the Indian IT pack as well. Thank you so much. Pleasure speaking with you.